Good afternoon, everybody. It is June 27th. This is Strategy Now here at MarketStream.live. My name is Joseph Cusick from the Cusick Group Securities offered by MoneyBlock. So I want to build off of yesterday's discussion on stock replacement. And today what I want to do is go over, as I promised, stock replacement 201. We're actually going to talk about doing cost basis reduction. So in other words, when you use an option that has 60, 90, 120 days, 250 days until expiration, the one thing that you always want to do is you want to reduce your cost. Same way with the stock. If you buy a stock, you don't want to pay retail. You don't want to pay the offer price. You want to pay a better price. And the only way that you do that is either put a limit order out there and wait, or you buy the stock and you sell another option, specifically a call option. It's called a covered right in the case of calls, or a covered put in the case of puts, where you sell an option against it to reduce your cost basis. So today what I wanted to do is walk through an example, and this is actually a real life example, one that I actually put on for my clients. Now, in full disclosure, I want to actually bring this up. A couple things, two things. Today's discussion, and I'm just going to go over this real quick. Any kind of stock option or future symbol that I'm using right now is basically for illustrative purposes. As I had said, I had disclosed earlier over the last week that I did have my clients exposed to a particular underlying that we had discussed in the NASDAQ. But this is not intended to portray a recommendation to buy, sell, or hold any type of security or strategy. Also, market conditions, well, you know what? They may vary from time to time. We're seeing it today. So basically, remember that performance, the volume, in other words, size that you do trades, tax factors, and so forth are always things that you have to consider, but by no means are we putting out a recommendation, and we do not offer any legal advice. This is content that's for educational purposes only and should not be used or produced or utilized otherwise. All right, I'm glad I got through that, and it's important. So what I want to do is talk about an example. We talked about the Qs, and as I have been saying over the last week or so, actually for the last month, I've had my clients in a position in the Qs. Initially, we were in the Qs as a bullish position. We'd actually, once we started getting a little tired and after the pullback that got me out of a long bull position, I then started to get a little bearish over the next 60 days. So what I wanted to do was actually put a position on for my clients that fit their profile. We can go long or short in my fund. And in this case, what I wanted to do is wanted to put a position on because the Qs were lagging. The NASDAQ was lagging, the S&P and the Dow Jones. And so we kept seeing that. And so I wanted to take an opportunity, especially since there was a little volatility there, unlike in the general market. So what I wanted to do was buy a put. All right. So on the open date of the trade, it was 622. The QQQs were trading at 140.70. So that's the ETF that tracks the Qs. I talk about it a lot on Strategy Now and all the other segments. Well, I wanted to buy a proxy for being short the NASDAQ. I don't want to be naked short the NASDAQ, but I wanted a proxy. And I bought the 144 puts and I had to pay $4.56 or $456 in premium. What does that give me the right? It gives me the right. So with the stock trading at 140, I'm short theoretically the Qs at 144, but I had to pay a price for that right, 456. Now, of course, I am not naked short because I own an option. I have to exercise that right to be naked short the market. My risk is the premium I pay, 456, that you can see on the screen. Now, one thing that you'll notice is that the difference between where the stock is trading and where my strike price is $3.30. That means the remainder of this premium, the 456, is what we call time premium, which is $1.26. And for me as a trader, as an investor, that's way too much premium. How do I offset that? Well, I'm going to sell, right? Now, these are expiring in August, so this gives me 60 days. So in a shorter time frame, I'm going to sell the July 138 puts. These expire on the 21st of July. That's in about 3 weeks from today. I sold those for a price of $121. The beautiful part is that reduced my cost basis almost by this extrinsic or time premium. So now I own these options for basically $3.35. So in other words, I'm short at parity with the market. So I am short basically at 140.70. I have no extrinsic or time and volatility premium at this juncture. So my total risk now is no longer $456, it's $335 per contract. I have a right to be short for 2 months, and I have an obligation that I might have to cover for the next month. I was willing to do that because if the market goes down, the 144 puts are going to appreciate. Yes, the 138 puts are going to appreciate, but the appreciation on these puts will offset this, plus time is always working against this option that I sold. So when you look at this graphically, you can see it looks an awful lot like a covered call, except it's reversed. We want the market to go down. So as the market goes down, we start making money. How much money? Well, if the market goes to 142, I don't lose any money. That's a real big plus. Okay? If the market goes to 138, I make $300 per contract. Now that has to happen over the course of time. If it happens in one day, you're not going to make this $299 or 89% on your investment, because both premium on the volatility as well as because of the fact not a lot of time has passed, there'll be still some built in here and here. So it's going to be far less of a profit, but still you'll realize a profit. And we'll get into that. So what I want you to come away with looking at this is that I have an opinion about the Qs. I think that they potentially could go down. It's currently trading at 140. So I'm going to buy a deep in the money put. I have to pay a decent premium for it, but it has a serious delta to it. In other words, as the stock moves down, and that's what I'm anticipating it's going to do, I'm going to have the ability to really rack up some potential profits. But I also know that I have a lot of time premium in this and volatility risk. If volatility goes down and time passes and the stock doesn't do anything or even goes up, that hurts these puts. So how do I offset or mitigate some of that or reduce my cost basis? I sell the out of the money 138 puts because I don't believe statistically that the Qs are going to get much below 138 between now and July expiration. So let's take a look at the summary of this. So there is risk with buying any type of what we call time diagonal spreads, whether calls or puts. You potentially could lose all of the premium that you pay for that strategy. So for example, in my example, I was buying a put diagonal. I was paying $3.35. My maximum risk is by August expiration that was basically 60 plus days at the time, because I looked at this last week. I could lose $3.35 if the Qs were over 144. Statistically, there was only about a 25% probability that it was going to be above 144. All options decay over time, whether they're long or short, but I'm muting that time decay factor on both the long option and also the short option because I'm long one, short one, so I'm basically just doing cost basis reduction on what I bought that was deep in the money. Always take a look at the tax obligations, right? These are short-term tax implications, and by no means am I giving you a tax or legal advice. But the one thing that I want to tell you is that I hardly ever, if never, make investment decisions based on tax consequences. No stock strategy can be done solely on the basis of taxes. That just doesn't make any sense to me, and that would not be the only reason why I did or did not do this. And always consider commissions. All right. Now, of course, if you ever have any questions on this, you can always email me at jcusick, JCUSICK, @moneyblock.com. And as a matter of fact, for those of you that sometimes go, yeah, I don't know if you really did this or not, here's the trade. As a matter of fact, I'll make it a little bit bigger and we'll scroll down. And like I said, this isn't advice, but what I wanted to show you was that on the 22nd at 11:05, we bought to open the 144 puts. We sold to open the 138 puts. We did a total of 40 contracts, and we did those for 435. What I did was I immediately put a price target out there of $4.20. Why? Because that was a 25% profit target. That's what I thought was reasonable with the environment we're in. And I got to be honest with you, I did not anticipate the move that we've had in the Qs. As a matter of fact, that resting order got filled today. With the Qs trading down now at the 139 mark, and we'll check, I got filled for a $4.20 credit. So basically, I made 85 cents on this over this time period over the last 5 days. That included a weekend. I didn't anticipate this pullback this quickly in the Qs, but what I did anticipate, though, was that on the 20-day moving average, and this is why I looked at it. Remember, this is where I instituted the trade on the 22nd. So right here, this is where this red bar right here, this is where I instituted the trade. It's been challenging its 20-day moving average. Any drop below the 20-day moving average means there's a battle on. So that's why I bought the 144 puts, because that was the last resistance level I saw. Okay, I'm just using the charts as visualization, and when the FANGs dropped, the Facebooks, the Amazons, the Netflix, the Googles, and there was a headline out this morning, the EU slapped Google with a 2.4 billion euro fine. But the point is, I didn't know that, I didn't anticipate that, but it happened. And so buying the 144s, that's the last level of resistance. I had a high probability that these would be in the money by August expiration, but I was just anticipating a pullback. The next level of support is right around the 138.31 level. We're at 138.35. So I anticipated that if it happened over the next 10 to 15 days, that I could easily pull this off for probably a 25 to 50% profit of the total debit that I put in there. So I put a 25% profit target out there, and lo and behold, with this pullback, with the Qs down 1.5% today, down 221 at 138.38, I executed the order to close that put diagonal. So it's an example of how you can go out and you can use these types of strategies. You have limited risk. You also have limited return. You're defining all of that. You're mitigating the things about options that often get people frustrated, which is, I don't understand time. I don't understand volatility. Well, by spreading that off, and especially in this environment where it's been overall low implied volatility, the diagonals, this is great. Even if we have an expansion of implied volatility, that helps that type of strategy. But really what I'm trying to tell you is that you can deploy capital in a very prudent way. In other words, I did small size on this, right? I did, a couple contracts for the clients so that it left cash on the sidelines when things got uncertain. This is an area where you get between the 20 and 50-day moving averages. There's some uncertainty. Even though implied volatility hasn't gone up a ton, the market is reacting, and specifically the Qs, and I saw they had a propensity, and we took advantage of that. All right, that's it for strategy. Now, as always, if you have any questions, you can email me at jcusick@moneyblock.com, or you can email info@MarketStream.live. Either way, we'll get back to you, and you can always go back and watch this video, whether it's on our Facebook page, MarketStream. Just go to Facebook, type in MarketStream, or you go to MarketStream.live. We are updating the archives as I speak. And as always, I can always send you a copy of the presentation if you would ever like one. All right, folks, that's it. I will be back this afternoon. I will be going over everything that's been going on in this very interesting trading day. See you then here at MarketStream.live.